With all the talk lately about a potential recession, and then there was that U.S. credit downgrade,
hmm
something about political turmoil.
Yeah, that definitely made headlines.
It's easy to feel a bit lost, like you're trying to navigate with a map that keeps changing.
Absolutely. There's a lot of noise out there.
So for this deep dive, our mission, really, is to cut through some of that noise. We want to pull out the key, useful insights from a whole bunch of sources.
Right. Make it actionable.
Exactly. We're looking at expert advice for, individuals, businesses. How to read the economic signals, maybe think about investing when things feel uncertain.
Mm-hmm.
The goal is really to help you feel more informed, more prepared, without getting bogged down in jargon or, frankly, doom and gloom.
Yeah, definitely. And we've got some great material to dig into. We'll be looking at practical tips from places like Equifax and Hope Credit Union on personal finance,
Okay?
how to think about diversifying your investments, what those economic indicators actually mean for you.
The nitty-gritty.
Yeah, the nitty gritty. Plus, some business preparedness advice from Dentons, the story behind that credit downgrade, and some investment ideas from NerdWallet.
So, quite a mix.
A really good mix. We're aiming to connect the dots and give you some solid takeaways.
Okay, let's dive in then. The big question that seems to be hanging over everything is this idea of a recession. What does that actually mean in practical terms?
Well, fundamentally, a recession is a pretty significant economic downturn. It's widespread and lasts more than just a few months.
Not just a blip.
Not just a blip, no. You typically see it as a drop in overall economic output. That's the GDP figure you hear about. And unfortunately, it often comes with higher unemployment, sometimes rising inflation, too.
Right. Like, thinking back, 2008.
Exactly. The 2008 housing crisis is a big example. Or even the very start of the pandemic in 2020, that sharp downturn. Those were recessions.
Okay.
But here's a key thing to remember. Recessions, while definitely not pleasant, are actually a normal part of the economic cycle. They happen. They're not like the end of the world.
Okay, so it's less about if it happens, and maybe more about being ready when it does, since it's cyclical. So, knowing that, what's the absolute first thing individuals should do? Like square one for getting financially prepared.
Square one, absolutely, is getting a really clear, honest picture of your own financial situation right now.
Taking inventory.
Exactly. Like before a storm, you need to ask yourself some basic questions. How much cash do I actually have readily available?
Right.
If something unexpected hit tomorrow, how quickly could I get more cash? What's my total debt? Picture credit cards, student loans, car payment, all of it.
The whole shebang.
The whole shebang. And critically, what are my absolute basic monthly living costs? Food, shelter, healthcare, getting around, childcare if you need it, just the essentials.
Hmm.
And also, are there any big expensive life events coming up soon? Knowing all that is your foundation.
It's like your personal financial snapshot.
Mm.
Okay, once
Yeah.
you have that clear picture, what's the immediate goal?
The primary goal, especially with economic uncertainty, is building an emergency fund.
Right, the safety net.
That's it. The standard advice is aiming for enough to cover 3 to 6 months of those essential living expenses we just talked about.
3 to 6 months. That can sound like a lot.
It can, absolutely.
Yeah.
And look, if that target feels overwhelming right now, the key insight is just to start. Even building up a smaller buffer, say $500 or $1,000, can make a huge difference psychologically.
Takes the edge off.
Exactly. It reduces that immediate anxiety and gives you a win, which helps you keep going to build the bigger fund.
Okay, that makes it feel more manageable.
Yeah.
So how do you actually start building that fund, especially if you're feeling stretched already?
It really has to start with a budget. You need to know where your money is going.
Right.
First, figure out your total household income, everything coming in. Then you've got to list all your monthly expenses. And be honest.
No fudging the numbers.
No fudging. Break it down. Fixed costs, rent, mortgage, variable costs, groceries, utilities, things that change. And don't forget those less frequent ones like annual insurance bills.
Yeah, those can sneak up on you.
They can. Once you tally it all up, you see the reality. Are you spending more than you earn, breaking even, or is there something left over?
Okay.
Then comes the tough part, maybe. Identifying essential versus non-essential spending. Really look hard at where you can cut back. Entertainment, eating out, subscriptions you barely use, maybe new clothes for a bit.
The wants versus the needs.
Precisely. You have to consciously separate those wants from your fundamental needs, at least while you're building that safety net.
Okay, so you've got the budget, you're tracking things. What about existing debt? That can feel like a huge weight, especially when things are uncertain.
Yeah, debt management becomes super critical. If your income does take a hit, you absolutely need a priority list for bills.
Okay, what's the order?
Priority one, without question, rent or mortgage. You need to avoid eviction or foreclosure at all costs.
Shelter first. Makes sense.
Second, your car payment, if you need that car to get to work or earn income. Third, student loans. If you're struggling, don't just ignore them. Call your servicer immediately. Ask about hardship options, different payment plans.
Be proactive.
Definitely. Fourth, credit cards. Try to make at least the minimum payment. If even that's impossible, call the company. See if they'll offer a temporary plan, but be aware they might freeze your card.
Good to know.
And fifth, medical debts. Try to keep up, but only after those other essentials are covered. Oh, and critically, if you buy your own health insurance, keep paying those premiums. Losing coverage is a massive risk.
That's a really clear hierarchy. What if you're just finding it hard to keep up generally, even before a major income drop?
Don't wait. Reach out to your creditors now. Ask about hardship programs. Can they offer interest-only payments for a while? Maybe forbearance, where payments are paused.
Right.
A modified schedule.
See what's possible?
Exactly. Explore everything. Maybe a personal loan from a bank or credit union could consolidate higher interest debt. Does your employer have any loan programs? Check that out too. And even if you're making payments okay right now, it doesn't hurt to ask lenders if they can lower your interest rate. Or call your utility companies. Do they have assistance programs? You won't know unless you ask.
Right, the worst they can say is no. Okay, makes sense. Shifting gears slightly. Beyond the personal finances, what about careers? Recessions often mean job market worries.
Yeah, that's unfortunately a reality. Unemployment does tend to rise during recessions, so being proactive about your career security is really smart.
What does that look like?
Start by refreshing your professional network. Reach out to people you know, current colleagues, former colleagues, industry contacts. Just reconnect.
Get those feelers out.
Exactly. And update your resume now. Polish up your LinkedIn profile or whatever platforms you use. Be ready, just in case.
Don't wait until you need it.
Right. Also, take an honest look at your skills. Are there any gaps? Could some online courses, certifications, or training make you more valuable, more employable? Upskilling, yeah. And even if your main job feels secure, think about a side gig. It can bring in extra cash, obviously, which helps build that emergency fund faster.
And gives you options.
And gives you options, a bit more flexibility. Plus, who knows where it might lead down the road.
Good point. Okay, let's circle back to that emergency fund. Given all this uncertainty, how hard should people be pushing to build that right now?
As hard as you reasonably can, really. The more you can sock away now, the better off you'll be if something unexpected happens.
Every little bit helps.
Every little bit. Look again at that non-essential spending. Can you cut back more on takeout?
Yeah.
That daily coffee? Impulse buys, it adds up faster than you think.
Okay.
And remember, if you do lose your job or your salary gets cut, using that emergency fund is exactly what it's for. Don't feel bad about it.
Right, that's its purpose.
That's its purpose. But
Okay.
And this is key. Once you get back on your feet financially, make rebuilding that fund a top priority again. You don't want to be caught short for the next unexpected thing.
Absolutely. Okay, this is all really solid advice for individuals. Let's pivot now to businesses. What should they be focusing on to prepare for a potential slowdown?
For businesses, a really critical starting point is remembering their employees are a key asset.
People first.
People first. Involve your team. Ask them for ideas on saving costs, improving efficiency. They often have great insights.
From the front lines.
Exactly. And before jumping to layoffs, explore other options. Reduced hours, temporary furloughs. See if you can retain your skilled staff. And communication is vital. Be transparent with your team about the challenges and your plans.
Okay, communication internally. What about externally?
Just as important. Talk to your customers. Reassure them you're reliable. Be ready to discuss maybe adjusting payment terms if they're struggling. Keeping those relationships strong is huge.
Makes sense. What other practical steps for businesses?
Get your paperwork in order. Seriously. Signed contracts, any collateral agreements, security agreements, guarantees. Make sure it's all buttoned up.
Dot the I's, cross the T's.
Yes. Review your contracts. Do you have late fee provisions? Should you be enforcing them? And just like individuals talking to lenders, businesses need to talk to their key creditors, banks, suppliers.
Proactive communication again.
Crucial. Show them you have a plan you intend to pay. Understand your loan agreements inside out, especially any covenants rules you have to follow. If you think you might struggle to meet them, tell your lender early. Don't wait for a crisis.
And maybe look at credit lines.
Good point. Consider securing or increasing your lines of credit now while things are okay, rather than waiting until you desperately need the cash. Access might be tighter later.
Okay, so tighten up operations, strengthen relationships. What about the core financials?
Yeah.
Debt, expenses.
Absolutely central. Prioritize reducing debt where you can. Rising interest rates make debt more expensive. Look at paying things down or maybe consolidating if you can get a better rate.
Trim the fat on expenses.
Definitely. Do a really thorough review of all business expenses. Where can you cut costs without hurting your core business, your revenue streams? Be disciplined.
And keep good records.
Meticulous records, accurate financials, and keep a very close eye on your cash flow forecasts. Knowing your cash position day to day, week to week, is vital in uncertain times.
Okay. Anything else businesses should be watching?
Know your counterparties, your key customers, your critical suppliers. Do a bit of due diligence. How financially stable are they? Could their problems become your problems?
Assess the whole chain.
Right. And maybe the most important advice for businesses: seek professional help early. Talk to your lawyers, your accountants. They can help you see the options clearly and make the best strategic moves. Don't wait until you're in deep trouble.
Get advice before you need it. Okay, we've covered a lot on preparation. Let's zoom out now to those economic indicators we hear about all the time. How reliable are they, really, for predicting what's next?
The crystal ball question, the honest answer. Economic forecasting is incredibly difficult.
Right. I've heard the joke about economists predicting 9 of the last 5 recessions.
Exactly. That joke exists for a reason. Even the top experts admit the limitations. Ben Bernanke, former Fed chair, famously said in 2008, right before things got bad, that the Fed wasn't forecasting a recession.
Wow, okay.
Alan Greenspan, another former chair, often spoke about the limits of prediction. And current chair Jerome Powell constantly emphasizes how challenging forecasting is, even in normal times.
So take predictions with a grain of salt.
A healthy grain of salt, yes. The indicators give us clues, context, but they aren't guarantees of the future.
Okay, noted. But with that caveat, what are the main types of indicators we should at least be aware of? What do they tell us?
Generally, economists talk about 3 main types: lagging, coincident, and leading indicators.
Okay, lagging first.
Lagging indicators change after the economy has already shifted. Think unemployment rates, the final GDP numbers, inflation figures like the CPI, business inventories. They confirm what's already happened.
Looking in the rearview mirror, kind of.
Pretty much, yeah. Useful for confirming trends. Then you have coincident indicators. These move more or less at the same time as the overall economy.
Like what?
Things like personal income levels, current interest rates, how much people are spending right now. They give you a snapshot of the present economic condition.
Okay, and leading, the ones that supposedly predict.
Right. Leading indicators are the ones that ideally change before the broader economy shifts direction. The source material didn't detail specific examples, but things often put in this category include building permits, surveys of consumer confidence, maybe stock market movements, though their predictive power is always debated.
Got it. Lagging confirms the past. Coincidence shows the present. Leading tries to hint at the future. You mentioned GDP and inflation, huge terms. Can we break those down a bit more?
Sure. GDP, gross domestic product. It's basically the total value of everything produced in a country over a period like a quarter or a year.
Goods and services.
Goods and services, exactly. It gets broken down into components. What we consumers spend, that's the biggest chunk in the U.S. What businesses invest, government spending, and net exports, exports minus imports.
Okay.
So GDP growth is a key measure of economic health. You also hear about hard versus soft data. Hard data is factual stuff: unemployment numbers, inflation rates. Soft data comes from surveys, consumer sentiment, business outlooks.
Opinions versus facts.
Kinda, yeah. And one more distinction: nominal versus real GDP. Nominal is just today's prices. Real GDP is adjusted for inflation, so it gives a better picture of actual output growth.
Inflation adjusted. Got it. And sometimes you see SA or SARE.
Right. SA means seasonally adjusted. They smooth out predictable ups and downs like holiday shopping spikes. SARE is seasonally adjusted annual rate. They take the adjusted quarterly change and project it out for a full year. Just ways to make comparisons easier.
Helpful context. And on inflation, it seems like there are different measures like CPI and something else the Fed watches.
That's right. The CPI, Consumer Price Index, is the one most people know. But the Federal Reserve actually focuses more on the PCE, core index personal consumption expenditures, excluding food and energy.
Why exclude food and energy?
Because their prices can jump around a lot for reasons unrelated to the broader economy, like weather or geopolitics. The Fed wants to see the underlying inflation trend, so they look at core inflation without those volatile items. Headline or all items, inflation includes everything.
Okay, so core versus headline. Good to know.
Yeah.
And these inflation numbers have obviously been a big story lately.
Huge story. Historically, inflation rates have varied a lot. If you dig into the components of CPI, you can see how energy prices, food, housing, healthcare, they all contribute differently at different times.
Fascinating. Are there specific surveys economists track to get a sense of future expectations?
Yeah, one well-known one is the Livingston survey from the Philadelphia Fed. They poll professional economists regularly on their forecasts for things like GDP growth, inflation, unemployment, interest rates per prime rate, treasury yields, even stock market levels like the S&P 500.
So, what the pros are thinking.
Exactly. Looking back at past surveys, say from late 2019 before the pandemic really hit, is interesting. You can see what they expected then versus what actually happened. It highlights how tough forecasting is.
Definitely puts it in perspective. Okay, let's talk interest rates now. How did they connect to all this, especially the recession risks?
Interest rates and inflation are closely linked. You can often see a correlation historically between CPI and yields on government bonds, like treasuries.
Okay.
Now, the term structure of interest rates, or the yield curve, basically just shows you the interest rate for borrowing money for different lengths of time, short-term versus long-term.
Right. Usually longer loans have higher rates.
Typically, yes. You expect to be paid more for lending money for 10 years than for 3 months because there's more risk and time involved. That's a normal upward-sloping yield curve.
Okay. But sometimes it inverts.
Exactly. That's the key phenomenon. An inverted yield curve happens when short-term rates actually become higher than long-term rates, so the curve slopes downward.
And that's bad.
Historically, it's been a pretty reliable warning sign for a future recession. Not perfect, but a strong signal.
How reliable?
Well, looking at past data, when the yield on the 10-year Treasury note drops below the yield on the 3-month Treasury bill, and stays there for a bit, like 10 trading days.
Okay.
A recession has often followed. The average lag time has been something like 300 days, give or take, so it's definitely something economists watch very closely.
The inverted yield curve.
Yeah.
Definitely want to keep an eye on that. Okay, so with all this uncertainty, potential recession, interest rate moves, what does this mean for investment strategies? How should people be thinking about their investments?
Yeah, in times like these, market volatility is pretty much a given. Things can feel very uncertain. That's why diversification is such a bedrock principle of investing.
Don't put all your eggs in one basket.
That's the classic way to put it, yes. It means spreading your investments across different types of assets, different industries, even different parts of the world.
So not just stocks.
Right. Think beyond just stocks. Include things like bonds, maybe real estate, mutual funds, which inherently hold a mix of things, perhaps commodities like gold, maybe even alternative investments depending on your situation, and risk tolerance.
Why does that help?
Because different asset classes tend to react differently to economic news. When stocks are down, maybe bonds are holding steady or even up, or vice versa. Having a mix can help cushion the blows when one part of the market is struggling.
Okay, so spreading it out is key. But how do you do that effectively? Is just owning lots of different things enough?
Not necessarily. Effective diversification is more strategic than just owning, say, 50 different stocks.
How so?
Well, for example, if you own stocks in 10 different tech companies, you're still heavily exposed if the whole tech sector takes a hit, right?
Right, they might all go down together.
Exactly. So you need industry diversification investing across different sectors like healthcare, energy, consumer staples, financials, in addition to tech.
Spread across the economy.
Yes. And geographic diversification. Investing some money in international markets can help offset a downturn just in your home country.
Global perspective.
And as we said, asset class diversification, stocks, bonds, real estate, etc., they react differently to inflation, interest rates, overall growth.
Okay. What are common mistakes people make?
A big one is thinking you're diversified just because you have many holdings, but they're all highly correlated, meaning they tend to move in the same direction at the same time. If all your assets drop when the market drops, you're not really diversified against that risk.
So you need things that zig when others zag.
Ideally, yes. You want assets with low or even negative correlation, things that react differently to the same market forces. And remember, diversification isn't something you do once and forget. You need to review and rebalance your portfolio regularly.
Why rebalance?
Because over time, some investments will grow faster than others, throwing your original allocation out of whack. Rebalancing just brings it back to your target mix.
Makes sense. How does someone figure out the right mix for them?
That really comes down to your individual risk tolerance.
What do you mean?
It's about both your willingness to take risks, how comfortable you are with potential losses, and your ability to take risks, how much loss you could actually sustain without derailing your financial goals.
Okay. What influences that?
Things like your age, younger folks usually have more time to recover from losses, so might take more risk. Your financial goals, saving for retirement decades away, is different from saving for a house down payment next year. Your income, your existing assets, even just your personality.
So personal.
Very personal. Younger investors might lean more towards stocks for growth potential. Someone nearing or in retirement might want more stable income from bonds. If you're unsure, talking to a qualified financial advisor is really a good idea. They can help you figure out your tolerance and build a suitable portfolio.
Good advice. Are there any specific sectors that tend to do relatively okay during recessions, historically speaking?
Well, according to NerdWallet's analysis, sectors like consumer staples often hold up better.
Staples. Meaning?
Companies making essential goods, food, drinks, household products, things people buy regardless of the economy.
Stuff you always need.
Exactly. And also the healthcare sector. People still need medical care, prescriptions, even when times are tough.
Makes sense. So how would someone find companies in those sectors?
NerdWallet suggests using stock screeners' online tools to filter for companies in those sectors, specifically looking for common stock.
Okay. But a disclaimer is probably needed here.
Absolutely. Huge disclaimer. Past performance is never a guarantee of future results. Just because a sector did well in past recessions doesn't mean it will this time. And you still need to do your homework on any individual company before investing. Due diligence is key.
Right. Don't just buy blindly based on the sector. Okay, we've covered a ton on prep and investing. Let's just quickly circle back to that U.S. credit downgrade we mentioned at the start. What's the main takeaway there in this context?
Yeah, that downgrade. One economist's take we saw was that it really highlights concerns about political turmoil potentially affecting the country's financial stability. The view was that it signals a kind of disconnect between, stated intentions to reduce debt and the actual policies being put in place.
So a credibility issue, perhaps?
That seemed to be the implication from that analysis, and we did see the stock market react negatively right after the announcement. So it's just another factor adding to the overall uncertainty influenced by both economic and political forces.
Another piece of the puzzle. Okay, so bringing this all together, after digging through all these sources, what are the main themes you think people should take away?
Well, first, that economic cycles, including downturns or recessions, are normal. They happen.
Not something to panic about, but to prepare for.
Exactly. Proactive preparation is absolutely key, both for individuals managing their money and for businesses navigating the market.
Okay. What else?
Understanding those economic indicators gives valuable context, even if forecasting isn't perfect. Diversification is just a fundamental tool for managing investment risk, especially when things feel uncertain. And finally, events like that credit downgrade remind us that broader economic and political factors are always part of the picture influencing our financial lives.
Yeah, it really does feel like taking concrete steps is the best response to uncertainty. Getting that financial picture clear, managing debt, building the emergency fund, thinking strategically about investments.
Absolutely. While the uncertainty itself can be unsettling, taking those actions we've discussed can genuinely boost your financial resilience. It gives you a greater sense of control, whatever happens next.
It empowers you, in a way.
It really does.
Yeah.
So maybe a final thought for everyone listening. Thinking about your own situation, business strategies, those big economic forces, what's maybe one specific thing you feel you can actually do starting today to strengthen your own financial footing for whatever might come?
A concrete next step.
Exactly.
Yeah.
Just one thing to focus on. And of course, we encourage you to keep exploring these topics, maybe dig into some of the sources we mentioned if you want to learn more.